wife needs to go back into surgery.
Oh no.
Yeah, it's her eye again. So like a couple weeks ago, but I don't think the audience knows. It wasn't worth mentioning there, but they her retina detached, and she had like an emergency surgery a couple weeks ago, and she's in recovery. But then it detached again. She was looking at it, just trying to like look through her eye and noticing it was kind of getting better, then got worse. And she called to the doctor today, and they said, yeah, it looks like it's detached again, and they're going to have to bring her in for another emergency surgery. She describes it, kind of look through that eye, as looking through a very thick gray fog. So if she's at a window or something, she says she can tell that there's light coming through the window, but if she's inside and looks at her phone, she can't see anything. And yeah, absolutely terrifying. So, and I saw like, it's also, messed up right after the surgery. Naturally, your eyes like really red and angry and messed up, and it was just kind of starting to heal. And now they're going to go back in and do like the same thing again. I like sew it back on or something.
You described to me what a total nightmare.
Yeah, right. I texted, and she's got to go through it again, man. So
that's just, I don't know what to say. I'm sorry.
Just gotta, it's tough. So, I mean, I'm mentioning this kind of to you because I don't know what the next couple of weeks are going to be like for recording and stuff. I think she's gonna, maybe one of the mistakes was she tried to go back to work too early. She's a tax accountant. It's tax season, and she's got a very strong sense of responsibility, and she felt like she had to get back in there and
she's a hard worker,
do her job. Yeah. And maybe she just too much stress or something. And that's what did it, whatever it is. So anyway, I don't know what's going to happen the next couple of weeks, but just FYI.
Got it.
The first one I wanted to talk about was the Trump debanking. We got a little bit of fresh news there. I don't know how up to date you are with that. Not or even what that's all about. Trump's suing JP Morgan.
Yeah, what is he suing for, like $10 billion or something?
$5 billion. Yep. $5 billion.
Oh, I'm sorry. I don't know why.
Why is that so funny?
I don't know. It just
$5 billion. It was a complaint, a kind of demand for a jury trial by him. The bit of that's not really news. The new bit that happened more recently had to do a response from JP Morgan, their defense. And if you look at the titles, is it like how some media that's sympathetic to Trump comes out? It's like, oh, they admitted it. They admitted to debanking him. And what they're referring to is they made public the actual like physical letter that they said, like, look, we're going to close your accounts. That's not really an admission. Right. It doesn't say in there we are. It's not like, quote, we have debanked you for political reasons. And then the thing is, though, the legal case, the biggest issue I think facing them is the actual agreement itself, the account. And this is why I think when I saw this, I sort of thought, okay, I think this is sort of an open and shut case here, because the agreement that was signed between Trump and JP Morgan had a clause in there. There's a line in the agreement when you open the account. Just says closing your account. Either you or we may close your account at any time for any reason, for no reason, without prior notice. Full stop. Right? We are not required to close your account at your request if you're pending transactions, yada yada yada. But it's just very clear. Like, look, we can shut this off anytime we want.
It all sounds super flimsy. Like, how do you prove it? Like, yeah, you can close the account at any time. It's almost kind of like at will employment. You can fire someone for any time, but not really for any.
That's exactly what it reminded me of. It's exactly what it reminded me of. Like when you get an employment, they basically will say either you or I can sever this relationship anytime either party wants.
But there's obviously lots of laws around discrimination and everything like that.
Right.
Is there anything like that for bank accounts? I really don't know.
I don't know.
But it would be extremely difficult to prove it on political grounds.
Right. So we'll see. I mean, I'm sympathetic to the idea. It's pretty rough to say, like, we're going to not, as a bank, we're not going to give the president, a bank account. We'll see where it goes. The other thing that I have here, I sort of downgraded this one. This was going to be the Iranian war. Joe, I sent you an email 9 days ago. This was March 1st. So I think this was Sunday morning. I'm trying to research what it is I want to talk to you about. And I was like, Joe, I'm putting down my prediction in writing. And then I basically predicted exactly what happened. And so we're not going to talk about that anymore. Welcome, Joe. I thought that was pretty good.
Yeah,
Or
but
do you remember it a little differently? So I wrote, after the strikes on Iran, questions on what will happen to the prices of oil and gas when markets open late today, Monday. Some suggest prices will spike to over $100 or even $120 if there's a full blockade of the strait. But then I said, I'm going to predict that the impact will be muted. I say $75 to $80, per barrel, before going back down by the end of the week when ships are moving through the strait, successfully getting insurance, etc. Iranian ONG has been pushed off the market for the better part of a year with the maximum pressure campaign, and Iran doesn't have the capacity to stop tankers from other nations getting through. The USA knows that getting tankers through is a priority. That was like my position on the first, and it held up pretty well. I think people were surprised that it wasn't higher going to the beginning of the week, and then just like at the end of last week. So this would have been like Thursday, Friday, March 5th and 6th. That's when it sort of spiked and went nuts. It definitely fell outside of my range. It was getting over, what was it, like 110 or something a barrel. But then
coming into Monday this week,
coming into Monday,
it was just under 120.
So it was like after the weekend, and then since then it's kind of come back down.
I mean, I think it's not even just the strait is one thing. I think it's the war itself. Has every day the war goes on, the fatter the tail gets of just a really catastrophic scenario. Today it's the strait that's blocked. If this thing keeps going, if there's attacks on fundamental infrastructure of some of the oil production in Iran or in some of the neighboring countries around it, that's the next thing that could happen that wouldn't even matter if the strait's open or not, for example. And just every day this war keeps going, just the probability of something left field like that happening just continues to rise.
Yeah, that's a good point. I guess I didn't really factor that in too well into the analysis. My focus was really on Iran. And where I was coming from was Iranian oil really hasn't been on the market anyway. So the fact that it couldn't get its out, BFD, basically. I said Iran didn't have the capacity to really stop anything moving through there. I guess there was a bit of a scare, and that's where the spike came from.
Come on, Luke, your Middle East geopolitics background.
Yeah, the lack thereof. I decided I wanted to put it in writing, and honestly, I didn't want to mention it at all unless I got it right. But let's just be forthcoming. If we make a prediction, we gotta check it.
That's how these things happen. Luckily, nobody remembers the wrong ones.
People, exactly. I'm sure people
all you need is one big home run.
Called it.
And then you can point to that thing. Just the man that predicted the oil market before the Iran crisis has
I'm going to predict
latest view.
Yeah. Anyway.
Yeah. But, so I mean, I think in general though, I think that's a fun idea. When something like this does happen, we should just put something down. Hey, here's what we think is going to happen.
Based on what we know,
we'll find out.
I work with models a lot, and that's really what you're doing. You're just constantly making predictions. Then you take a look at what actually happened, and then that's how you add sort of knowledge and understanding into the model. And that's the feedback loop. And then next time, hopefully you'll have it with fresher eyes. So this is a journey. I mean, I think part of this podcast is just to document our journey in just becoming better bankers, better at finance, econ, and all that stuff. It's a long journey, and we're not going to try to sit here and claim to know everything. We don't. What we do not know is far, far greater than what we do know, but we're just going to try to be honest, learn as we go. And hopefully you guys will come along for the ride. The other, kind of to that same vein, the next thing I wanted to talk about was also as part of a fallout to what happened in Iran was the Korean stock market. Not something I know anything about. So let me just become forthcoming with that. Decided
it's been a big
theme,
learning opportunity.
Yeah, exactly. Well, hopefully, hopefully it's pretty clear that one of the reasons why I like and enjoy doing this podcast is it gives me an opportunity to learn about stuff that I don't know anything about. It gives me sort of a creative outlet because in the past I would read up about it and then I would be like, oh, that's interesting, and then just forget about it. Now I can read it and sort of give a somewhat productive outlet for it. so I can read about it, and then I can turn it back and spit it at you, Joe. But
That's
like,
right.
um, so one of the things I learned when kind of this whole Korean thing, I was like, oh, okay, that's kind of interesting. And I made this little cartoon. I think a picture is worth 1,000 words. It's going to be the Korean stock market, the KOSPI. And he's sick in bed. And the doctor comes and he said, tests are back. Over concentration. You need more random walks, and for goodness sake, ease off the chips. And then he's got his little chart at his feet where it just shows Samsung is like 30%, and then this SK Hynix company or something is another 25%. It's like that stock market is mostly those two companies when you look at the index. And then those two companies, what are they doing? Tech stuff, chips, even. So it's, I saw that and I was like, oh wow.
Yeah,
I did
it's
not
kind of
I
like
did not really appreciate
uh,
that. Yeah, I knew
mhm.
Samsung was a huge company. I didn't realize it was like such a huge chunk of
Right.
their index.
I don't have the exact numbers, but like Iceland around 2008, some huge percentage of like all of their financial markets were like one or two banks. At the height of the banking crisis, like I think that stock index was down like 14% or something like that at one point that day.
Yeah. You get a special day of the week plus a black in front of it. Jobs report came in under estimate by quite a lot. That caused a little bit of a stir. I'm sure you have much more of a view or opinion on that than I do about
Yeah, it
that.
was. So I mean, it was super negative. I think what it was like minus 92,000 jobs.
Yeah.
That's a really bad sign. That's something you'd see at the onset, or getting into a recession. Numbers like that. There was caveats around it, though. The two big ones were that one, it included this ongoing healthcare strike in California. People estimated it was that 92,000 was probably inflated by about an extra 30,000 jobs or so.
Oh, interesting.
And the other main point, and I don't know as much about this, but I think they also had just updated their birth death model of
Uh,
business birth death model as well. So
that's huge. That could be
I
huge.
don't have it. Yeah, yeah. So that one was also flagged as like being really sensitive. It could really have a big impact on it. So undoubtedly, it's no good. But markets didn't panic on it. I think a combination of a couple of those caveats, plus just everything else going on, people weren't looking for another piece of extra bad news.
Oh, okay. That's interesting. Yeah. And by the way, we did a really in depth look as to where those numbers come from, the employment numbers, and how important the birth death model is versus the yearly adjustment and all that kind of stuff. So the other thing, even just looking at the month over month change, it's sort of zigzaggy quite a lot. And that to me says that there's something wrong just with the collection of the numbers. I don't know about you, but when like I see it something where you would expect all theory would point to some gradual one way or the other. But instead this is like it's like this big zigzag.
Right.
Up a lot, down a lot, up a lot, down a lot. And to me that says something's up with the data. So or the model or the calculation or just like the sample. Again, I got a lot of questions.
Absolutely. And
Yeah.
yeah, and it's like if you talk to Stephen Myron, that's one of the things they would say, like that's why we should have been cutting for a long time. It is volatile month over month, but it is clear also like the 2 year trend now is just steadily downward, more and more and more.
Yeah.
So that's probably a part of the reason why also markets didn't sell off so badly on that day on the news. Not great. It's a continuation of this kind of gradually deteriorating job market. And so now that would say, maybe the Fed needs to cut more. At the same time, we've getting inflation pressures from this kind of uncapped oil price right now. Still, no one knows what's going to happen. So labor pressure in the labor market weakening plus inflationary pressures that puts the Fed and kind of all central banks for that matter in a very difficult spot.
All right. Some of the bigger or juicier topics I wanted to talk to you about. The first thing, have you heard of Erebor Bank?
No.
It's not on your radar yet. It's a new bank. So it's they got issued a national banking license just like this past week. That's pretty rare just by itself. You don't really issue a whole lot of those lately. De Novo banks, as they're called. One of the things I know that, Miki Bowman has said is she wants to see more de novo banks, sort of ease up on the regulation. That's a theme of this administration, try to get some more innovation going on here. So its founder was Palmer Luckey. You know who that is? Co-founder of Oculus VR and Anduril Industries. So that's one of the tech.
Oh, interesting.
Yeah, defense tech industry. Well, he has his own bank now. Erebor is sort of an interesting name. Does that ring a bell?
Erebor.
Oh,
like
yeah,
the interbank offering rate.
Yeah, that's a rate. That's like an interbank offering. No, not that. Erebor. 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 That's a reference to The Hobbit, J.R.R. Tolkien. That's the Lonely Mountain. That's the one with the big treasure guarded by the dragon. That's Erebor. So, like, I watched this interview with Palmer Luckey, kind of trying to figure out what this is all about. And if you listen to him talk, he even referenced Silicon Valley Bank.
He understood my businesses, the things that I was doing. Silicon Valley Bank was doing a reasonable job, but then they went out of business and took everybody's money with them and had to have the government bail everybody out. And I think that was really kind of the thing that got me very serious about it.
He's almost sort of positioning himself as Silicon Valley Bank's successor. He says, there are special banks devoted to doing agriculture. You got banks that are good at construction. They serve communities in different ways. Why doesn't tech have their own bank that really understands the business? And you're like, okay, I guess that's kind of cool. And then you kept listening and he started talking about...
There's a lot of other things that you get from having a bank that is strongly aligned with the United States, strongly aligned with U.S. interests, strongly aligned with the U.S. Department of War and also the intelligence community.
And you're like, what is going on? Okay. That's kind of out of left field.
You gotta pander to those giving out banking licenses.
That was my take too. I was like, okay, that's kind of neat. And then I think what he dropped the real reason was
also a lot of things that new technology enables, like using US dollar-backed cryptocurrencies to have 365, 24/7 settlement of payments.
You're like, oh, that's what this is. It's stable coins. It's stable coins. You're making a stable coin bank. And I think the reason why is because what?
Stable coins are like a money market fund, but they don't pay interest.
Yeah. Stretch it out here. Give me a little more.
Really, really profitable.
So profitable. Yeah. They're just printing money. I mean, we looked at this before. You actually kind of, I think, showed this to me. Tether. And like their business model. And I think even Chamath or something hinted at it on one of the All In podcast things where he just said, amazing business. It's an amazing business.
That is an incredible business.
What do they got, 150 billion in treasuries now?
What he means by that is like it's stupid profitable.
It just makes a ton of money.
It just makes a ton of money. I mean, like just to give a sense, let's get to like, some numbers here. A bank, you got liabilities and you got assets. And liabilities, you pay a certain percent interest, right? That's your interest expense. And then on assets, you earn some interest. And the idea is you want to get that gap as much as possible. They sort of have a joke in banking, right? You got to do the 3-5-3 rule, right? So you borrow at 3%, you lend at 5%, and then you hit the golf course by 3 p.m., right? It's the 3-5-3 rule in banking. Okay. Borrow at 3%.
It's easy as that.
You're paying 3%. Okay. But you're earning 5% and you get to take home and you pocket the 2%. These stablecoin like Tether, they're like legal. Since the Genius Act came about, they are prohibited from paying interest. So the amount they're paying is not 3% in this 353. It's 0%. They don't pay anything. Zero. They can't. And then what they're earning on the other side is treasuries. So like 4%, some sort of short-term thing, 3-4%. You can do repos, whatever money.
Treasury bills.
Yeah. And then you just pocket the whole thing. It's also, they're not going to be like a commercial bank that has a bunch of branches and stuff all over the place. They're not paying for any real estate. It's just all online. You can do this with like a couple people, basically. Like one of the biggest expenses they're going to have to deal with and navigate has to do with sort of that whole nod he made towards defending America's interests. What that is, that's basically the Bank Secrecy Act and anti-money laundering. And that's going to be, in my guess, is going to be his biggest expense. You're going to need a team of people to make sure that there isn't any sort of illicit activity going through. That, again, is also something that's in the Genius Act. I think there are a bunch, and we talked about this before when the Genius Act first passed. There's a lot of technical hurdles involved with doing that with something like stablecoins, I imagine. But I could see a tech company, being able to somehow figure that out. So, so like they have a huge spread between what they're earning and then what they're paying. They get to also pocket any transaction fee. So like, how Visa and MasterCard, they're going to get a fee. Visa and MasterCard, let's call it like 2%, 1.5% or something goes to the banks. And I think stablecoins are going to undercut that by a lot. Maybe it's 50 basis points. Maybe it's 25 basis points. But they're going to be, stupid numbers of transactions in this potentially. And that's all just going to be green moolah. That's going to be the good stuff, And then you're paying some people some salaries. I mean, it's stupid how profitable Tether is. Stupid. And, people
but
in
it's
crypto
like
and stuff.
transaction fees just for scale. It's like you're saying, might be 50 basis points, but just that interest though, they're making 350 easy.
There's this concept in banking, a very important metric called NIM, the net interest margin. And that basically is the difference between what you're paying in interest and what you're earning from the asset side. And you want to get that as wide as possible. The wider you can get it, sort of the more efficient a bank is. The NIM in banking in general is like 3%, 3 a little more, but that's with risk, right? But that's also, they're taking on risky loans. This is one of the things that he also talked about in that interview. He said, let's see if I can find it.
Focus on the things that they care about. That's probably not going to be, for example, residential mortgages, but things like equipment financing, very conservative, very conservatively played, where it's not going to turn into a risk management problem.
I got to say, I think he's talking out his ass a little bit. Equipment financing. I guess what he's referencing are like ABL loans, asset-backed loans. I guess, but like those aren't particularly conservative. It's not like those don't have risk. But whatever. Yeah. I mean, he kind of is pushing the fact that we're going to be a super safe bank. But that's a stablecoin. That stablecoin is supposed to be super safe.
And then also just kind of positioning oneself as kind of a successor to Silicon Valley Bank is a little bit ominous as well, because there's still no great answer to what could have prevented Silicon Valley Bank. Yeah, maybe the regulators could have stepped in sooner, you could argue, but the key issue was just the absolute speed and scale of the run on the bank. So if he positions himself that way, not talking about that key risk and pointing to things like asset-backed loans as to why his risk will be lower, it just, not knowing anything about it, just hearing those 2 points, that would not make me sleep well at night as a, risk manager for a bank or as a regulator.
This is like this is what's so insane about this kind of whole model is you could just hold straight up cash at the Federal Reserve and still bank a 3+%. Like, what is the interest on overnight reserves at the Fed right now? What is it?
I think it's 360.
365, yeah. So like you could easily just put it all in cash. So imagine like it's which is zero risk. And it would be zero run risk because it would just be cash anyway. So like imagine that you have a stable coin, you want to go leave it with them, give them $1. They turn around, put that dollar in the Fed as pure cash, straight cash. And they're earning 3.65 from the Fed and they're paying you 0. And you have a team of like 3 people managing this. I mean, on $1 billion.
Right.
You're going to be earning.
So even if there was a huge run on the bank,
just be cat.
Just take your money out of the Fed.
Don't care because it's already there. 1-to-1.
So that's actually functioning more like a money market fund. You're not really acting like a bank anymore. You're not extending loans, at a higher interest rate and paying on a lower. You're just intermediating cash between you and the Fed. What was the name of the bank we talked about like a year ago now that was like its pitch? That was like its business model pitch. Basically just give people access to that.
TNB, the narrow bank.
Yeah.
So just those, there was a former guy, I think it was a former supervision guy at the Federal Reserve. He wanted to set up, just for background, he wanted to set up a bank called the narrow bank, where that's exactly what he did. He just said, leave your cash with me. I'll dump it at the Federal Reserve. I'll pay you what they're paying me minus 10 basis points. and I'll pocket the 10 basis points and I'll give you the rest. And the Federal Reserve, I think, did something kind of sneaky. It didn't really list a solid reason why they shouldn't be given a charter. But they also knew, and I kind of agreed with, if they did this and they actually attracted a huge number of reserves, because who wouldn't want to earn 3.5% on just like a demand deposit account? The problem is that would suck out so much of the funding that are used by banks now to give out loans, and it would just drain all the credit that people need. So they didn't give it to them. But that's the TNB, yeah. So there's definitely there are big concerns out there now regarding what's going to happen with stablecoins. Like how much of the total reserves is it going to drain out of the system? That's an open question. We don't really know the answer to that. We'll have to just kind of play this experiment out and adjust as we go. Yeah, the next thing I wanted to talk to you about, Joe, was this whole shadow banking, private credit, bank credit, public credit, blue credit, green credit. There's like a billion different names. I'm just making up the last few. What are shadow banks?
They work in the shadows.
Yeah, they're just bad. They're definitely just whatever it is. I don't like it. That was my kind of gut reaction. I first sort of read about shadow banks in China. When I was in China, following the Chinese economy really closely.
Shadow Chinese banks,
and I was like, even clearly worse. Those are bad. Why don't they do anything? What are they? So like the delineation between a bank and a shadow bank really has to do, it's because of the regulators. And a bank, when we say the word bank, what we're normally talking about, or pretty much what we're always talking about, is a depository institution. They take deposits. The reason why depository institutions, banks as you and I sort of use the word, why they're so heavily regulated and what makes them different from everyone else, what makes them so special, is the fact that I have my deposit account with them. So from like the government's perspective, that's like a sacred entity that cannot go down, and we're going to regulate them like utilities. So they are regulated through and through, because the main reason is because they are funded by you, by me, by our viewers. We have our deposits there and they can never go down. Shadow banks do not hold deposits. They're funded, if you will, by investors, by like people buy in people. So it could be like retail investors, high net worth people who are trying to make a little more yield, will put some money into a fund, which is it's a separate legal entity, put it into a fund, and then that will use that cash and they will lend it out. Oftentimes it's not so much lending so much as buying securities. So like a quote unquote public credit might be they'll take the investor's money and they'll put it in things like publicly traded debt securities. So corporate bonds, investment grade, non-investment grade, by treasuries, kind of the money market funds that you were talking about. Those are like quote unquote public credit or something, and they'll get a higher return and they'll be able to return
regulate
that to
so
investors.
They have to report on what they're actually holding. Every now and again, you can see what the securities are. You can see what the prices are. It's made to be regulated to be very transparent.
Yeah. So the regulator then is not going to be like the Fed or the FDIC or the OCC, the ones who regulate the depository institutions. Those are going to be like the SEC. And then what we're talking about, what got in the news lately, had to do with these private credit. Now, what they do is they also gather investors' money, but what they have much more of a credit focus. They're going to issue individual loans similar to what a bank does that are tailored specifically to whatever the borrower needs. So a typical bank, again, depository institution, they have a client and they meet with the client and they say, what exactly do you need? We're going to make a loan tailored just for you. Mm-hmm. Securities don't work like that. They just say, okay, we're going to, I need to raise this much money. This is my company. You get maybe a rating agency to say if it's good or bad or kind of what the credit rating is. And then it just goes out and it's got pretty standard set of terms and stuff like that. And it can be, traded and sold pretty regularly.
It's got liquidity.
Exactly. So that's the thing, right? So like when there's a loan, that's given that's specifically tailored for a separate individual. These loans, the contract, are hundreds of pages long. I don't know if you've actually seen like a loan contract. A loan is just a contract.
Yeah.
It's a contract. And it can be super long and super complex. They have all these different covenants, if this, then that, and you got to pay these back. We're going to track your metrics, and you got to let us know this and that, and give us this information.
These lawyers got to do something all day.
Yeah, exactly. The lawyers and bankers have to do something. But the point is, they can
before
be
that 3 p.m. golf. Sorry.
The point is, yeah, basically. I mean, the point is, like, at the end of the day, when you have these private credit people that issue a bunch of tailored loans to individual people, you can charge a higher interest rate. But part of the cost of that has to do with the fact that they're illiquid. It's very difficult for you to turn around and sell them because there's so much special information associated with them. That's what we heard about lately with all this private credit stuff in the news. Blue Owl, Blackstone created this H-Lend thing, had been in the news coming up a bit lately, and it all had to do not so much with the credit quality of the funds. They weren't really concerned. Well, it didn't. A couple of things going on here. One is people, they have, when you go and put money into the fund, they'll say that you can only pull out like 5% or something, the balance of the fund every quarter. And that's because it's a fundamentally illiquid fund. Okay. Your entire loan book is going to give you a certain amount of principal and interest every month, and that'll generate some liquidity. But in general, they're going to take those funds, and they're going to turn around and they're going to try to lend it back out so they can keep these like 10% or whatever returns going. What made the news is people tried to pull their money out. It surpassed that 5%, and they got kind of hit with a wall, and you couldn't go anymore. And that's to be expected. It's just the nature and structure of the fund. Now, why investors wanted to pull this money out, that's a separate story. They might be a little jittery. They might think that, Blue Owl, for instance, is going to be giving a lot of loans to tech companies, and maybe they feel as though the tech industry is a little bit shaky with the amount of money that's going into AI and kind of all the stories around there. But the story around not being able to get their money out of Blue Owl or something, and like, we should be outraged or something at Blue Owl, didn't strike me. It's particularly that huge of a deal. It would be more of a story if you actually looked into the fund and got to see if there were some serious credit problems. Like if they started having a large percentage of their loans moved to non-accrual, that would be a problem, meaning they're, not being paid down. That would be a problem.
Which you can't really see that well, if at all.
Yeah, they report on it, and I dug into it, and they do report sort of the non-accrual numbers. I think I pulled Blue Owl. The numbers wasn't outrageous. It wasn't anything you would expect. Now, all that said, to your point, it can be very difficult, and certainly a credit department at a bank, one of their jobs is to go in and say, hey, how much do I think our losses are going to be? And that's some art, some science. And there's a lot of room for, if you don't
Finger
know,
in the air. That's how it's done.
Just give them some time.
You can't trade these things.
Give them some time. Maybe it's fine. We're not going to write it down. And whereas banks are just regulated up the wazoo, and they're going to have bigger banks, right, are going to need to really justify every single loan. And they literally have regulators come in, and they look at a sample of loans, and they review those loans, and then they challenge those. I don't know if that also happens at Blue Owl. I guess they probably have auditors. I don't know, but the SEC certainly isn't doing it. Some auditors might, but that's a question mark. That's a question mark.
It's very difficult to do. And the fundamental issue, like with the headlines recently, I think was kind of two things. One was, in recent years, they opened up these funds to retail investors, which I guess traditionally it wasn't as popular of a thing.
Right. Yeah, right.
Retail investors can be, I think by definition are more finicky than institutional investors. They'll pull their money quickly if they get scared. When they buy in, though, they're subject to these terms that, this is an illiquid credit fund. But one of the covenants in it was that you can withdraw your money up to 5%, valued at par. So one of these funds in Blackstone, actually, like one of the other huge private credit shops, investors started pulling their money, and Blackstone actually, they put up the fund's own money, as well as they talked to like their executives to put up like another couple $100 million to basically fill the gap. It was kind of seen like an admission that these things aren't really trading at par, but we have to fulfill your withdrawal requests at par. But with these credit funds, you just can't value them on a regular basis.
Right.
So that's kind of the pressure point that they're at right now.
Yeah.
If they hit too many withdrawals like that, even if they're within that 5%, they could, like, the fund could still kind of, run out of capital.
All right, kind of the other thing along the lines of the shadow banks has to do with a speech. I don't know if you heard our girl Miki Bowman gave a speech, and she wants to bring mortgages back on the balance sheet of banks. How about
that? Briefly through you, I think.
Oh yeah. Maybe I mentioned this on kind of what I wanted to talk about.
It's funny. I follow the Fed so closely. Fuzzy. But not the supervisory side, to be perfectly honest.
Yeah, not the supervisor. This is something that I was kind of interested in and drew my attention. The bulk of mortgages are not originated. They're not issued by depository institutions, bank that you and I would know. Ever since 2008, the share of loan originations by depository institutions has been shrinking from, I think it peaked at around 60% down to something like 35% today. And it's been replaced by these non-bank lenders like Rocket Mortgage. It's kind of these other weird names that you could probably find online. And they'll give you a loan real quick, and then they'll turn around and they'll sell it, right? They'll sell it off to Fannie and Freddie. They'll pocket a little bit, and they'll just rinse and repeat. Like, why were these mortgages sort of forced off the balance sheet after 2008?
I don't have a great answer for you.
It was really fascinating for me to learn just how important these regulatory and specifically the capital rules are in terms of shaping sort of the financial landscape. So like when you get a mortgage, so if I go to Chase, I got my mortgage with Chase. Every month I got to give them, I got to pay my mortgage, and it goes to Chase. Now it's possible though that Chase doesn't actually have my mortgage on their balance sheet. Okay, it's possible that they sold it. It's very possible that they turned around and they sold my mortgage off to Fannie and Freddie. And then that cash flow, that mortgage that I pay, eventually is just going to land in the investor somewhere else, right? Whoever's holding the MBS. But obviously they don't want to like bug me having to say, oh, by the way, we sold your mortgage. Don't pay us this money. Go and pay so-and-so who actually owns, they're not going to do that. They're still servicing my mortgage, so to speak. They're the one, I guess they handle, they'll handle the escrow accounts that I pay into. If something were to have to handle with the house, God forbid, they need to foreclose it in something, all this administrative stuff that's around just having a mortgage and dealing with a home and all that still lands with Chase. Now Chase, because of the service that they provide, they have a mortgage, servicing right. They have a certain claim on the future cash flows from the mortgage that I pay. They'll take a little bit for themselves. And it's an asset on their balance sheet. Okay. It's a claim that they have to some sort of future revenue. It's an asset. And they'll pile a bunch of these off together. Now, the thing is, the capital treatment of those MSRs is nuts. It's insane. So like we talked earlier about, this is like getting kind of technical, but I think it's worthwhile. We talked earlier on an episode how, when you hold capital, you don't hold it against the total assets. You hold it against the risk-weighted assets, which is to say, if you have an asset that's super risky, then the risk weight is going to be high, say like 100%, 200%. If the highest, it's going to be like 1,250%. In order to calculate how much capital a bank has to hold, it'll take all of their assets and it'll put them in a big list. So they'll have cash, they'll have treasuries, they'll have MBS, they'll have residential mortgages, they'll have, commercial mortgages, wholesale mortgages. It gets super complicated, okay? And then they'll add up all the balances and multiply it by some sort of risk weight. And on one extreme, you could have a bank that's just 100% treasuries, zero risk weight. Okay. At that point, you don't have to hold any capital. If you're a stable coin, all you had was Fed cash, your risk-weighted assets would be zero. So it would just be 0 times whatever you held, and you didn't have to hold any capital. Now, there are some backstops to that, which we won't get into, but just for our purposes, that's what's going on. A pretty high risk weight, like a commercial loan, is like 100%. What do you think the mortgage servicing rights are?
I mean, if agency MBS are 20%, I don't know, like 50% range maybe?
They're 250%.
Oh,
That's crazy. I mean,
yeah.
and then, but the other thing, so that basically means that you have to set aside a certain amount of capital. You've tied up capital when you have those MSRs on your books. Yeah. Okay. You can't. A lot
of capital.
You have to put out a lot of capital. Yeah. That's one thing. The other thing with these MSRs is that they have a deduction threshold. So if you have the MSRs on your books and they exceed like 10% of capital, of the balance of capital, effectively every dollar after that, you have to hold 1-to-1 with capital. So like basically another way of putting it is the risk weight jumps up to 1,250 for everything that's over a balance of these MSRs that you have over 10% of the capital that you have.
So you have to 1,250%.
Yeah.
So the capital you have to hold is over 12 times the amount of the loan?
No. It's just 1-to-1. So this is kind of strange how the reason, like, where does this 1,250 come from, that number? I'm talking about risk weights. So when you do this like risk weight math, so like,
yeah.
Okay. So the thing is, the other number is like what's considered well capitalized is 8% of your total assets. So if you want to calculate it for like $1 of an asset, in order for the math to work out so that you have another $1 in capital, you're multiplying that dollar by 1,250, 1,250%, and then you're multiplying it again by what's a well-capitalized bank, 8% of assets by 8%, and you get back to 1-to-1 capital. That's where that 1,250 comes from. You follow me? It's a little complicated because we're talking about risk weights. We're sort of skipping a step. The point is the capital cost of holding mortgages and turning around and selling them, even holding mortgages themselves, are pretty high. The thing is, after 2008, and they identified correctly that the cause had to do with way too much, housing and residential loans on the books, what did the regulators do? Well, they just made it really expensive to hold residential mortgages on the books so that this doesn't happen again. But it had the off effect of just now pushing the mortgages off to a different sector, off to non-banks, and now they're not being regulated as closely. It's just funny how you can tweak this tiny thing and just see how banks react.
Like a seemingly esoteric number somewhere.
Tiny little tweak.
Mortgage servicer rights, risk-weighted asset amount went up by X%.
Yeah.
The whole banking sector's in trouble. Excuse me. What?
Well, yeah, it's protected
not
certainly
that much,
against,
but it's
mean, to be fair, the banking sector is probably very well protected against another housing downturn. To be fair, they solve
because of these levels.
The deposits, yes, your deposits, you at home, you, Joe, me, our deposits are safe from a housing downturn because of that rule. But Mickey's like, I think banks should maybe issue a little more mortgages. Anyway, that's all I had for you today, Joe.
Cool.
A little loop around some stuff happening in the finance world. This is what kind of we're talking about. And now you, people at home, get a little bit of an insight. Let us know of some other professionals that have similar podcasts like this. I'm kind of curious to see what doctors get around to talk about. Oh, did you hear about that new drug? What do they talk about? Oh, you see that new rule? I can't, give, I don't know. I can't meet with
new
elders without talking to. Yeah, exactly. Oh, it's really going to change my whole life. Or like lawyers, oh, they're proposing a new law. It can't work in Delaware anymore because fucking, I don't know. I did have a thought, like, what if we had a roundtable of I have a friend of mine. He's a doctor, oncologist. You can get him over here. I have a lawyer friend. Get him over here. and we just go around and be
Yeah.
like, what do you guys freaking talk about? You meet
pretty
you
cool
bump,
episode.
you bump into another lawyer at a law. Like, how do you kick it off?
Yeah.
Oh, you see that article in the Lawyer Times? Can you believe it? What an idiot!
I'm right there with you. It's pretty much the extent of my knowledge.
If it exists, I don't know about it. I would like to know about it. That's
Yeah.
what we're trying to do here on this podcast. Like, this is what sort of finance people a little bit talk about. And otherwise, give wish my wife the best. I mean, I'm worried about her.
Absolutely. Yeah.
And otherwise, I'll see you next time. Try to give you guys an update. See you next time on another episode of the Root of All Evil podcast. I'm Luke.
I'm Joe.
All right. Take
See you
care.
then.
Bye.